Okay, let's unpack this. Imagine you've always dreamed of owning a piece of the real estate market, maybe, collecting rental income, watching property values climb. Sounds like a classic path to building wealth.
It really does. It's the dream for a lot of people.
But then reality hits. The mountain of cash needed for a down payment, the tangled mess of mortgages, the sheer hassle of being a landlord, late night calls about a broken furnace, tracking down rent, finding reliable contractors.
Yeah, the landlord horror stories are definitely out there.
For most people, especially those without a huge pile of cash sitting around, getting into real estate feels like scaling Everest without any gear. It just feels out of reach.
And that barrier to entry, that's exactly what traditional real estate investment represents for, well, the vast majority.
Yeah.
It's really capital intensive, it's illiquid, and it requires significant ongoing management. It's just not designed for the average individual investor looking for, say, diversification or passive income.
But what if there was a way to chip away at that mountain? To get exposure to real estate assets without buying an entire building, without getting a mortgage, and crucially, without dealing with leaky pipes at 3 a.m. Our sources delve into a mechanism that makes this not just possible, but, increasingly accessible. We're talking about real estate crowdfunding the pooling of resources online to invest in property.
It's a significant evolution, really, in real estate finance. It's opening doors that were previously maybe just ajar for institutions or the ultra-wealthy.
Right.
However, as our sources make really clear, navigating this space comes with its own set of considerations, including understanding the fundamental rules around who is legally permitted to participate in certain types of these investments. And this leads us right into the fascinating and sometimes, frankly, frustrating world of the accredited investor definition.
Which might sound like dry regulatory stuff, but it's absolutely central, isn't it, to understanding access and opportunity in private markets, including crowdfunding.
Couldn't be more central. It dictates who gets to play in this sandbox.
So our mission in this deep dive, guided by the sources you've shared, from market analyses to regulatory reviews, is to pull back the curtain on real estate crowdfunding. We're going to define what it is, explore why you might consider it, break down the essential factors for choosing a trustworthy platform.
Which is super important.
Yeah, and dissect that critical accredited investor rule, and even peek into the future at how technology like blockchain might reshape this whole market.
We'll try to go beyond the headlines, distill the most important nuggets of knowledge, maybe highlight some surprising facts tucked away in the details, and really aim to give you a shortcut to being genuinely well-informed on this, dynamic corner of the investment landscape.
Let's dive in then. So let's start at the beginning. Forget the jargon for a second. At its heart, what is real estate crowdfunding?
Okay, think of it this way.
Yeah.
Instead of one person buying one property, right? Real estate crowdfunding is a group of people coming together, typically facilitated by an online platform, to pool their capital. And they collectively invest in a real estate project. Now, this collective capital can be used in a couple of primary ways based on what the platform offers.
How so?
Well, it can be used to purchase physical property outright, like an apartment building or a commercial space. Or, and this is quite common, it can be used to provide capital to real estate developers or operators.
Like a loan.
Exactly. In the form of a loan that is secured by the real estate asset itself.
Okay, so it's not just owning a piece of a building. It could be essentially being a lender to someone who is building or managing a building. Is that right?
Precisely. That's the fundamental distinction between equity crowdfunding and debt crowdfunding. With equity, you own a share of the property or the project itself.
Got it.
With debt crowdfunding, you are lending money, and your loan is backed, secured by the value of the property. Most platforms offer one or maybe both models.
Understanding that difference is pretty key, I imagine.
Oh, absolutely. Because the potential returns and the risks, they differ significantly. With equity, you participate in potential appreciation and rental income, but you're subordinate to lenders if things go wrong.
Yeah.
With debt, you typically receive fixed interest payments, which potentially offers more stability, maybe predictability, but you don't usually participate in the property value upside. You just get your interest and principal back, hopefully.
Got it. So instead of that traditional scenario where I'd need a huge down payment and get tangled up with banks for a mortgage just to own one rental house,
Yeah, the whole 9 yards.
crowdfunding lets me contribute a much smaller amount, perhaps a few $1,000s, maybe even less sometimes, into a larger pool alongside other investors.
Precisely. It directly contrasts with that traditional path, which demands substantial capital upfront for a down payment, navigating complex mortgage processes, and then taking on all the responsibilities of being a property owner.
Yeah.
Like ongoing maintenance, finding and managing tenants, handling property taxes, insurance, utilities. I mean, the list just goes on and on. Crowdfunding bypasses much of that operational burden.
Okay, so I've put my money in the pool. How do I actually gain exposure to the asset or the project that the pool is funding? What does that look like?
Yeah, so the sources detail how the platform facilitates this. Investors contribute their capital through the platform's online portal. Pretty straightforward, usually.
Okay.
Once the total funding target for a specific project is met, the capital is deployed. Then, investors gain exposure, either by becoming direct shareholders in a legal entity that owns the property, that's the equity model,
Right.
or by purchasing fractional ownership in a promissory note or loan secured by the property, that's the debt model.
And that legal entity managing the property isn't me, thankfully. Phew. What structure is typically used for that?
Right, you're not getting the calls about the toilet. That's where entities like privately held real estate investment trusts or REITs or perhaps special purpose vehicles, SPVs, come in.
REITs and SPVs. Okay.
The pooled capital is typically held and managed by one of these structures, created specifically for that investment. And the sources are careful to note, these are distinct from the large, publicly listed REITs that trade on major stock exchanges like the NYS.
Ah, that's an important distinction. So these aren't the same REITs I might buy through my brokerage account.
Generally, no. Public REITs offer high liquidity. You can buy and sell shares easily, but you're investing in a massive portfolio managed by a large corporation. Crowd-funded private REITs, or SPVs, are usually focused on a specific set of properties, maybe even just one single property.
Okay.
And they are definitely not easily traded. Liquidity is much lower.
So it's less like buying a share in a company that owns, I don't know, Walmarts across the country, and more like being a part owner of that specific apartment building down the street or that particular retail plaza project being developed.
That's a really good way to think about it, yeah. And the breadth of properties available through these platforms can be quite surprising, actually, drawing from the sources.
Like what kind of things?
You can find opportunities in core residential properties like single-family homes aggregated into portfolios, apartment complexes, or even individual condo units. You can also invest in various commercial real estate sectors, including retail spaces like malls or strip centers, hospitality properties like hotels, or office buildings.
Wow, okay.
It really offers a way to diversify beyond just one type of property, which is a big plus for many investors.
And the platform itself is the critical link in all of this, the intermediary.
Absolutely. The platform acts as the crucial intermediary. Its responsibilities include sourcing potential investment opportunities, performing initial due diligence, and vetting on those opportunities. That's key.
Vetting, right?
Presenting the details clearly to potential investors, facilitating the flow of capital from potentially hundreds or thousands of investors to the project, and then handling the distribution of any income or profits back to the investors. They connect you, the individual investor, to the real estate deal.
Okay, that paints a clear picture of what it is and how it works on a basic level. So why would someone choose this path? What are the compelling advantages that make real estate crowdfunding worth considering, especially compared to, say, buying a property directly or even investing in one of those publicly traded REITs we just mentioned?
Yeah, good question. The sources highlight several key advantages that really seem to resonate with individual investors. The most obvious one, which we sort of touched on, is the significantly lower barrier to entry.
The cost, right?
Exactly. Traditional real estate often requires tens or even hundreds of thousands of dollars just for a down payment. Many crowdfunding platforms allow you to invest with minimums starting in the low thousands, sometimes even lower, like maybe $500 to $1,000, depending on the platform and the deal.
Wow, that's a huge difference.
It really is. This opens up real estate investment to a much, much wider segment of the population.
So it sort of democratizes access to the asset class, making it possible for people who otherwise just couldn't participate.
That's the word people use, yeah, democratizes. And that lower minimum investment ties directly into the next big advantage. Enhanced diversification.
How so?
Well, when you buy one rental property, 100% of your real estate investment is tied up in that single asset in one location, subject to that local market's dynamics, right?
Yeah, all your eggs in one basket.
Exactly. With crowdfunding, you can potentially spread that same amount of capital, or maybe even less, across multiple properties, different types of real estate, residential, commercial, industrial, and various geographic markets.
Spread the risk around.
Precisely. This diversification is crucial for mitigating risk. If one investment underperforms, well, maybe others might still do well, buffering your overall returns. It's a fundamental investment principle applied to real estate.
Diversification across different properties and markets definitely sounds appealing for risk management. What about returns? How do investors actually, make money from this?
Okay, the primary appeal here, for many, is the potential for passive income. Just like a landlord collects rent, the properties invested in, through crowdfunding, generate income, usually from rents.
Okay.
This income is typically distributed to investors on a regular basis, often monthly or quarterly, providing a stream of passive cash flow.
Passive income. Nice.
Additionally, investors often participate in any property appreciation. If the value of the underlying asset increases over the investment term and it's eventually sold at a profit, investors receive a share of those gains. The specifics depend on the deal structure, of course.
Passive income without the landlord duties. That's a powerful combination for many people, I bet. Are there other benefits?
Yeah, compared to direct ownership, there's a significant advantage in simplified management. As we discussed, the day-to-day stuff, operation, maintenance, tenant issues, all that is handled by the project sponsor or the managing entity, like the private REIT or SPV.
So you're hands off.
Your role as an investor is passive. You typically receive reports and distributions, maybe some updates, but you're not dealing with the operational headaches. The platforms also often provide a degree of transparency, giving investors access to documentation, performance updates, and details about the underlying assets and the business plan.
So you get the potential upside and income streams of real estate without the heavy lifting of property management. That's a huge draw, I can see that. But it can't be all sunshine and rainbows, right? What are the potential downsides or risks a listener should definitely be aware of?
You're absolutely right. It's crucial to be realistic. The sources are very clear that real estate crowdfunding is not without risks. The most significant risk, bluntly, is the potential for investment loss.
Okay, you could lose your money.
Yes, real estate values can go down, projects can fail. Business plans might not be executed successfully for various reasons. The distributions you anticipate might not materialize or might be less than expected. You could lose some or potentially all of your invested capital.
That's important to emphasize. Definitely not guaranteed returns. And you mentioned liquidity earlier. Is that a drawback too?
Yes, that's another major consideration. Reduced liquidity, especially when compared to publicly traded assets like stocks or those traditional public REITs.
How so?
Well, you can buy or sell shares of a public company or a REIT pretty much instantly during market hours. With a private crowd-funded real estate investment, your capital is typically locked up for the investment term.
And how long is that usually?
It can vary quite a bit, but it's often several years, maybe 3, 5, 7 years, sometimes longer, depending on the project's business plan. There's often no easy secondary market to sell your stake quickly if you suddenly need access to your cash.
So you really need to be comfortable with your money being tied up for potentially quite a while.
Exactly. It requires patience and a longer-term perspective. It's not for money you might need next month or next year.
Okay, so you need to be comfortable with your money being tied up. Understanding those risks, potential loss, illiquidity is just as important as understanding the benefits. Now, for someone who hears all this and thinks, okay, this sounds promising, maybe worth exploring, the next logical step is figuring out where to invest. There seem to be dozens, maybe hundreds of these platforms out there now. How does someone choose the right one for them?
That's a critical question. And honestly, the sources provide a pretty good roadmap for this. Navigating the platform landscape is definitely challenging because they vary significantly.
In what ways?
Well, they have different investment minimums, different fee structures. That's a big one to watch, different levels of transparency. And maybe most importantly, they offer different types of investments. Some focus purely on debt deals, others on equity. Some offer individual deals you pick yourself. Others offer pooled funds like those private REITs we talked about.
So lots of variation.
Tons. You absolutely must research platforms to find one that genuinely aligns with your financial goals, your risk tolerance, and crucially, your eligibility. Eligibility, right? That brings us back to the accredited investor idea again, which we definitely need to unpack. But setting that aside just for a moment, What are the core criteria you should use to evaluate a platform? The Financial Samurai source, I think, provided a great framework here.
It does, yeah. It cuts through a lot of the marketing hype. The first key criterion they highlight is deal flow.
Deal flow, what does that mean exactly?
This isn't just about the sheer number of deals available, although that matters. It's also critically about their quality. A platform with robust deal flow means they're consistently sourcing new investment opportunities.
Okay, why is that so important?
It's vital because it gives you, the investor, more choices. More choices mean you can be selective and find deals that genuinely fit your specific investment strategy and your diversification goals, rather than feeling pressured to invest in one of only, say, 2 or 3 options available at that moment.
Right, you don't want to feel forced into something. Exactly. You want a platform that's attracting good opportunities, not just, scraping the bottom of the barrel to have something listed. Quantity and quality of deals.
Okay, so quality and quantity of deals available is the first sign of a healthy platform. What's next on the checklist?
Information availability. This might sound obvious, but it's actually surprising how much platforms can differ in what they disclose and how easily accessible it is.
What kind of info are we talking about?
You need easy access to comprehensive information. This includes platform-level performance data, things like the total dollars invested through the platform over time, the total distributions paid out to investors, and ideally, aggregate performance metrics like the average internal rate of return or IRR across their realized deals.
Realized deals. You mean seeing how investors on the platform have actually performed overall on completed investments?
Exactly. And here's a critical nugget from the sources. Don't just look at the average IRR on all deals listed, or just the projected returns. Look specifically at the number of realized deals.
Why is that distinction so important?
Because it's a crucial indicator of a platform's maturity and experience. A platform with only a few realized deals might have performance metrics that look great, but they could be skewed for night, maybe one really successful project, or conversely, one failed project can dramatically swing the average.
Ah, I see.
A platform with a substantial number of completed investments provides a much more reliable track record and much better context for their reported performance figures. It shows they've actually gone through the full investment lifecycle acquisition, operation, exit, not just started projects.
That's a fantastic point. Look for realized deals, not just listed deals or projections. What about information on the individual investment opportunities themselves?
Yeah, for each specific deal presented, the platform should offer in-depth documentation. This means a clear, detailed business plan for the project. What does the sponsor actually intend to do? Renovate, lease it up, build something new, sell it quickly.
You need to know the strategy.
Absolutely. You also need comprehensive information about the asset itself, its location, condition, size, current occupancy, things like that. Data on the local market is essential. Population trends, job growth, comparable property values in the area, and finally, detailed information about the sponsor or manager of the project. Who are these people? What's their track record?
So the platform needs to give you basically everything you need to do your own thorough due diligence, right?
That's the goal. Transparency on specific deals, plus platform-level metrics on completed projects. That sounds like a solid basis for your research.
Okay. What about the platform's process for selecting which deals even make it onto their site in the first place? How do they filter?
That falls under the umbrella of quality control and vetting. A reputable platform doesn't just list any deal that comes their way, or at least they shouldn't. They should have a rigorous, ideally clearly published process for reviewing and selecting opportunities.
What does that process look like?
The sources suggest looking for platforms where this vetting involves experienced real estate professionals, maybe an internal team with deep industry knowledge, or perhaps a dedicated investment committee. A transparent vetting process builds trust.
How so?
Well, it helps you feel confident that the opportunities presented have met a certain minimum standard of quality and viability. It minimizes the risk of the platform just operating as a simple bulletin board where basically anyone can list a deal, which could potentially lead to, pay-to-play scenarios where sponsors pay just to get listed regardless of quality.
Okay, so a strong vetting process helps filter out the weaker deals before they even reach you, the investor. Does that process also influence the type of deals a platform can attract?
Absolutely, it can. Think about it. Developers and sponsors with strong track records and high-quality projects are generally more likely to want to list on platforms known for their rigorous vetting and discerning investor base.
Creates a positive feedback loop, maybe.
Exactly. Good quality control attracts good sponsors, which leads to higher quality deal flow, which in turn attracts more sophisticated and discerning investors. The sources note that a platform's ability to attract quality of sponsors and managers is absolutely paramount.
Why so critical?
Remember, the sponsor is the one actually executing the business plan on the ground. They're managing the property, doing the renovations, finding the tenants. Their experience, their track record, their financial stability, their expertise in that specific type of real estate or market, these are all critical to the investment's ultimate success or failure.
So you're not just investing in a property, you're really investing in the team managing it.
Precisely.
Yeah.
You should definitely investigate the sponsors the platform works with. Look at their history, how many projects they've successfully completed, maybe their total assets under management. Larger, more established sponsors often have access to deals that are typically reserved for institutional investors, think, premier properties in prime locations.
So a platform consistently working with high-caliber sponsors is a good sign.
It's a very strong indicator of its own quality and network, yes.
Okay. And the final criterion from that financial samurai source?
The final one was market insights and education. A good platform isn't just a marketplace. It should also be a resource for its investors.
How so?
Well, the expertise of the platform's own team influences the deals they curate and their ability to provide valuable market context. Do they share their investment philosophy? Do they offer insights into market trends that help you understand why they think a particular opportunity is attractive right now?
Like explaining their reasoning.
Exactly. Many platforms provide educational content, things like webinars, blog posts, detailed performance reports, maybe conference calls with management, which can be incredibly helpful, especially if you're newer to real estate investment or maybe unfamiliar with a specific property type, like, say, self-storage or industrial warehouses.
So look for a platform that's not just transactional, but also educational and transparent about its own approach and market views? Makes sense. The sources did mention Fundrise as one example platform in the US, right?
Yes. Fundrise was noted, particularly because it's structured to be accessible to non-accredited investors.
Ah, okay.
It does this primarily through its focus on diversified REITs, which are their version of those private REITs. It's an example of a platform trying to lower that accessibility barrier we talked about. Though its model is a bit different from platforms offering direct investment in individual properties or specific debt deals. It offers a more hands-off, pooled, diversified exposure to real estate portfolios.
Okay, that framework for choosing a platform is incredibly helpful. Lots to look for there. Now let's circle back to this concept that keeps popping up, the accredited investor. You mentioned it's a significant hurdle. Let's really dissect what that means and why it matters so much in this world of crowdfunding and private investments.
Yes, let's do that. It is arguably the single biggest gatekeeper in U.S. private capital markets. The concept dictates who is legally allowed to participate in certain types of private securities offerings that aren't registered with the SEC in the same way public stocks are.
And many crowdfunding deals fall into that category.
Many do, yes, especially those offering direct equity or debt in specific projects. Its origins, interestingly, trace back nearly a century, born out of a period of pretty significant financial turmoil.
A century? Wow, we're going back pretty far then.
Yeah, all the way back to the aftermath of the 1929 stock market crash and the Great Depression that followed. In response to the widespread financial devastation and, frankly, the loss of public trust in the markets, Congress passed the Securities Act of 1933.
Okay, a landmark piece of legislation.
Absolutely. It established the fundamental rules for the public issuance of securities, primarily mandating registration and extensive disclosure requirements. The goal was investor protection, ensuring people had access to crucial information before investing.
So the 1933 Act was primarily about making public markets safer through transparency and disclosure.
Exactly. However, Congress also recognized that some securities offerings, particularly private ones made to a limited group of investors, didn't necessarily need the full, costly, and time-consuming registration process demanded for public offerings.
Like selling shares in a small business to just a few relatives or something.
Sort of, yeah, or raising capital from sophisticated institutions. These private offerings were granted exemptions from full registration. But this immediately raised a critical question. If these offerings were exempt from the stringent public disclosure rules designed to protect the average investor, who should be allowed to invest in them?
Ah, and that's where the need for a definition like accredited investor came in, to identify who could handle these riskier, less transparent deals?
Precisely. The regulatory framework needed a way to identify investors who, presumably, either had enough financial sophistication to understand the risks involved in these less regulated private deals on their own, or who were wealthy enough that a potential loss wouldn't be financially ruinous for them.
So it was about sophistication or ability to bear loss?
Correct. The definition was developed to delineate this class of investor who could participate in these exempt private offerings without needing the full protections afforded by public registration and disclosure.
So what were the original criteria established back then, or formalized later, to define this sophisticated or wealthy investor?
The definition as we largely knew it for decades was formalized in the SEC's Regulation D back in 1982. It was primarily based on strict, bright-line financial thresholds.
Okay, what were they?
To be an accredited investor, an individual generally needed to meet one of two main criteria. First, a net worth of more than $1 million.
$1 million?
Yes, but with a specific exclusion, the value of their primary residence didn't count towards that million.
Okay, so $1 million in investable assets, essentially outside your home. What was the second path?
The second path was based on income, an annual income of over $200,000 for an individual, or over $300,000 in joint income with a spouse. And there was also an expectation that this income level would continue in the future.
$1 million net worth, excluding home, or $200K, $300 income. Wow, that immediately locks out a vast majority of the population, doesn't it? What was the underlying assumption behind those specific numbers?
The assumption was fairly straightforward, if perhaps a bit simplistic. It was that meeting these high financial thresholds was a reliable proxy for either financial sophistication or the ability to absorb significant investment losses.
A proxy, okay.
The regulators basically assumed that if you had that much wealth or income, you either understood complex investments well enough to protect yourself, or if the investment went sour, losing the amount you invested wouldn't fundamentally alter your financial well-being. It was essentially a wealth-based definition serving as a stand-in for perceived sophistication or risk tolerance.
I can see the logic maybe from a regulatory protection standpoint, but it feels incomplete. Does having money automatically mean you're smart about investing? I know plenty of wealthy people who aren't financial wizards.
And conversely.
And does not having that much money automatically mean you're not smart about investing or can't understand risk?
You've hit on the absolute core criticism of this wealth-based approach, a criticism our sources articulate very clearly, and that persisted for years. Critics argued quite compellingly that wealth or income alone is a poor, imprecise indicator of true financial knowledge or sophistication.
It seems obvious when you put it like that.
The definition was often described as being both over-inclusive and under-inclusive.
How so?
It could be over-inclusive by including wealthy individuals who perhaps inherited their money or made it in a completely unrelated field and lacked any real investment experience or financial literacy. They met the threshold but weren't necessarily sophisticated.
Right.
And it was simultaneously under-inclusive by excluding highly knowledgeable individuals, maybe finance professionals just starting their careers, economics professors, savvy entrepreneurs who hadn't hit those thresholds yet, who understood finance deeply but simply hadn't accumulated that level of wealth or income.
That's a really powerful critique. It suggests the definition wasn't actually measuring what it claimed to be measuring sophistication. Did this criticism lead to any changes over the years?
It certainly created pressure for change, which built up over a long period. Then, following the 2008-2009 financial crisis, similar catalyst to the 1930s, interestingly, there was a renewed focus on capital formation and also on investor access.
Okay.
The JOBS Act, passed in 2012, didn't immediately change the accredited investor definition itself, but it did pave the way for new frameworks like Regulation A plus SAV, sometimes called Reg A plus AC.
What did that do?
Reg A plus allows companies to raise capital from unaccredited investors, not just accredited ones, although typically with investment limits based on the unaccredited investor's income or net worth. It showed a regulatory willingness to start thinking about expanding access, albeit with different rules and safeguards.
So the idea of allowing broader participation beyond just the wealthy was gaining some traction. When did the definition of accredited investor itself finally get a significant update?
The most significant formal changes came much more recently, with the SEC adopting amendments to the definition in August of 2020.
2020, okay. What were the goals there?
Well, the stated goals from the SEC were pretty ambitious. They aimed to modernize the definition to better reflect today's markets, provide a more robust foundation for assessing the whole system of exempt offerings, simplify and improve efficiency in capital raising, promote capital formation, and critically expand investment opportunities while still maintaining appropriate investor protection. Quite a balancing act.
Indeed. Okay, so what were the concrete changes for individuals? How could someone now qualify as accredited besides just meeting those long-standing income or wealth thresholds?
This is where the amendments attempted to introduce sophistication as a direct path, not just as a presumed consequence of wealth. For individuals, new ways to qualify were added based on holding specific professional certifications or designations.
Ah, like licenses.
It's exactly. The SEC specifically listed certain exams administered by the Financial Industry Regulatory Authority, or FINRA. Passing exams like the Series 7 General Securities Representative, the Series 65 Uniform Investment Advisor Law, or the Series 82 Private Securities Offerings Representative, now allows an individual to qualify as an accredited investor regardless of their income or net worth.
That's a big change, directly recognizing professional knowledge in finance, finally. Were there any other new ways for individuals to qualify?
Yes, another path was added for individuals who are knowledgeable employees of a private fund. Essentially, if you work for the fund and are involved in its investment activities, you'll likely qualify.
Okay.
There was also a small but practical update to the joint income and net worth calculations. It formally allowed spousal equivalents to be included, acknowledging modern relationships beyond just traditional legal marriage for those joint thresholds.
Got it. And what about for investment entities like firms or funds? Were there changes there too? Did they broaden it for institutions?
Absolutely. The definition was also significantly expanded for various types of entities. It formally included registered investment advisors, both those registered with the SEC and state regulators, and even those operating as exempt reporting advisors.
Okay, advisors themselves are accredited.
Yes. Also, rural business investment companies, RBICs, were added. Crucially, limited liability companies, LLCs, that meet certain asset thresholds, $5 million in assets, generally, were formally included as accredited investors. The sources note this was largely bringing the rule text in line with existing SEC staff interpretations, but it clarified things.
And family offices.
Yes, and finally, family offices with significant assets under management, typically over $5 million, along with their family clients, were also formally designated as accredited investors.
So the 2020 amendments certainly seem to broaden the tent quite a bit, adding knowledge-based paths for individuals, expanding the types of eligible entities. That sounds like a major step towards addressing some of those long-standing criticisms we discussed, right?
It was undoubtedly a step, yes, and it was generally welcomed by many in the industry who had long advocated for modernizing the definition. However,
there's always a however, isn't there?
Often is in regulation. The sources also present a fairly strong critique, arguing that while these steps were positive, the 2020 amendments ultimately did not go far enough, particularly in significantly expanding access for individual investors based on sophistication rather than just wealth.
Not far enough. But they added professional certifications. That seems like a direct nod to knowledge.
They did, but the actual impact on the total pool of potential individual accredited investors was surprisingly limited, according to the SEC's own estimates cited in the sources.
How limited?
The SEC estimated that the upper bound, the most optimistic scenario of newly eligible individual investors resulting from that certification pathway, represented no more than a 4.2% increase in the existing accredited investor pool.
Only 4.2% increase on the existing pool.
Correct. And when you look at the total U.S. adult population, the increase was even smaller, a mere 0.2%.
Wow. 0.2% of the population newly eligible through the knowledge path. That's an incredibly small sliver compared to the vast majority who remain excluded based on wealth or income. Why was the impact so minimal if they added those certifications?
There are a couple of key reasons the sources point to. Firstly, there's significant overlap. Many individuals who already hold those professional financial certifications, like the Series 7 or Series 65, likely already met the income or net worth thresholds established back in 1982.
Ah, so they were already accredited anyway.
Many probably were. So while the rule added a new path on paper, it didn't necessarily add many new people to the pool. Secondly, obtaining these certifications isn't trivial. It often involves costs for study materials and exams, significant time commitment, and in the case of the Series 7 and 82, requires sponsorship from a FINRA member firm, typically an investment bank or brokerage.
Which can itself be a hurdle if you're not already working in that specific part of the financial industry.
Exactly. It's not like just anyone can easily decide to go get a Series 7 license just to become accredited.
So while the intent might have been to recognize knowledge, the practical outcome was that it largely benefited people who were probably already qualified by wealth anyway, or those already deeply embedded in the traditional financial services industry. The definition still heavily favors money over demonstrated smarts for most people.
That's precisely the critique articulated in the sources. The definition, even post-2020, remains overwhelmingly skewed towards measuring financial capacity to withstand losses rather than actual financial literacy or investment capability. The primary path to accreditation for most individuals is still having high wealth or income.
And you mentioned the expansion for entities, firms, advisors, family offices was much broader relative to the expansion for individuals.
Yes, and this raises another subtle but important concern highlighted in the sources. This disproportionate expansion of the definition for institutional entities relative to individuals could inadvertently steer individual investors towards accessing private markets only by investing through these accredited entities, like investing in a fund managed by an accredited advisor or family office.
What's the issue with that? Isn't getting access through a fund better than no access?
It provides indirect access, yes. But it can also introduce layers of fees, management fees, performance fees, add complexity, and potentially create conflicts of interest between the fund manager and the individual investor. The individual doesn't get direct access to choose specific deals. They get mediated access, often with added costs and less control.
That's a fascinating point. It might open the door a crack, but only if you pay a toll to a new gatekeeper, the fund manager, instead of qualifying directly. Was there any other major criticism leveled at the updated definition that the sources mentioned?
Yes, the sources also touch on the persistent issue of geographical disparity. The fixed income and net worth thresholds, set decades ago and never adjusted for location, simply don't account for the vast differences in the cost of living across the United States.
Right. $200,000 income means something very different in rural Iowa versus Manhattan.
Exactly. That $200,000 annual income goes a lot further and is frankly harder to achieve in percentage terms relative to the median in a lower cost of living area than it does in major coastal cities like New York or San Francisco. An equally knowledgeable or capable investor in the Midwest might not qualify based on income, while someone in California, simply due to higher regional incomes and, importantly, higher property values significantly influencing net worth, might easily qualify.
So your eligibility is partly determined by your zip code, not just your financial acumen or even your absolute wealth relative to your local economy. That seems fundamentally unfair.
It's a very valid point of critique regarding the fairness and effectiveness of a national one-size-fits-all financial threshold. The SEC itself actually acknowledged this geographical inconsistency in their rulemaking process for the 2020 amendments, yet they ultimately made no adjustments for it.
They knew it was an issue but didn't change it.
Correct. The sources also briefly mention other potential changes that were discussed or proposed by commenters, but ultimately not included in the 2020 amendments. Things like implementing geographic adjustments, maybe a two-tiered sophistication test, perhaps including a direct SEC-administered test option anyone could take, or setting investment caps for certain types of accredited investors, similar to limits in Reg J+.
So the conversation is still ongoing about how to fix this.
It shows that the debate about how to truly define and identify a sophisticated investor, balancing protection and access, is far from settled and continues among regulators, academics, and market participants.
Okay, so we've established what real estate crowdfunding is, why it's appealing, how to vet platforms carefully, and the complex, evolving, and still somewhat frustrating landscape of the accredited investor rule, including its significant shortcomings. Now, let's shift gears a bit and look at a technological trend that our sources suggest could fundamentally change the future of real estate investment and perhaps even interact with this whole regulatory discussion. Tokenized real estate powered by blockchain.
Yes, this is where things get really interesting, potentially disruptive. The emergence of blockchain technology is itself a significant shift, partly fueled, somewhat ironically, by that same skepticism in the traditional financial system that followed the 2008 crisis.
How so?
Well, think about Bitcoin's origins. It appeared shortly after the crisis, conceived partly as a reaction against central banks and the perceived failures and opacity of traditional financial intermediaries. Blockchain offered a different model.
So blockchain isn't just about cryptocurrency speculation then. There's more to the tech.
Oh, far more. At its core, blockchain is a decentralized, distributed digital ledger technology. Think of it as a shared, tamper-evident database. It records transactions in a secure, transparent, and immutable way across a network of computers. Once the transaction is added to the chain, it's incredibly difficult, if not practically impossible, to alter it retroactively without the consensus of the network.
Secure and transparent record keeping. And platforms like Ethereum introduced more functionality beyond just simple currency-like transactions.
Exactly. The sources mention Ethereum as a key development because it popularized the concept of smart contracts.
Smart contracts, what are those?
They are essentially self-executing contracts where the terms of an agreement between buyer and seller, or lender and borrower, are directly written into lines of code. This code runs on the blockchain.
So the contract enforces itself, in a way.
That's the idea. This innovation has the potential to automate processes, remove intermediaries, like escrow agents potentially, and enhance trust and transparency in various markets by making agreements executable and verifiable without relying solely on traditional legal systems or manual enforcement.
Okay, so a transparent, secure, programmable ledger. Where do non-fungible tokens, NFTs, fit into this picture? We mostly hear about those in relation to, like, digital art or collectibles.
Right, that's where they got famous. NFTs are a specific type of token that exists on blockchains like Ethereum, unlike a cryptocurrency like Bitcoin, where every Bitcoin is identical and interchangeable fungible, like $1 bill is the same as another. Each NFT is unique and represents ownership of a specific, distinct asset.
Non-fungible means not interchangeable.
Exactly. This uniqueness is the key. It allows NFTs to represent individual items, whether those items are digital, like art, or increasingly physical assets in the real world.
And the connection to real estate is using these unique digital tokens to represent ownership of actual physical property.
Precisely. This is the core concept of tokenized real estate. It involves using blockchain technology and NFTs or similar unique digital tokens to represent fractional or even full ownership interests or equity interests in real-world physical properties.
So instead of holding a traditional paper deed or maybe shares in a single asset LLC that owns the property, your ownership could be represented by a digital token recorded securely on a blockchain.
That's the vision, yes.
That sounds incredibly futuristic. Is this actually happening in a meaningful way right now, or is it still mostly theoretical?
It is happening, and the market is definitely growing, but it's absolutely still in its very nascent stages. The sources mention recent growth in the market capitalization of tokenized real estate projects, which indicates increasing activity and interest.
But it's small compared to the traditional market.
Oh, incredibly small. It's absolutely crucial to have perspective here. This market remains remarkably tiny and significantly undercapitalized when compared to the multi-trillion-dollar global traditional real estate market. It's a tiny, tiny fraction of the overall pie right now.
Okay, early days, but growing. High potential, maybe.
Very high potential, according to proponents. It's a fraction that's growing, attracting attention, and has, proponents argue, immense potential to change things.
So what are the specific benefits that blockchain and tokenization could bring to real estate investment, according to the sources? Benefits that might address some of the historical challenges and pain points we've already discussed, like cost and liquidity.
The sources highlight several potentially transformative benefits. Firstly, as you hinted, it could lead to significantly reduced transaction and administrative costs.
How?
Think about a traditional real estate transaction. It involves numerous intermediaries, brokers, lawyers, title companies, escrow agents, recorders, each adding fees, complexity, and time delays. By using smart contracts and a shared, trusted digital ledger, many of these processes could potentially be automated, streamlined, or even eliminated, potentially lowering costs dramatically.
Cutting out some of those middlemen could be a huge cost saver. What about that liquidity issue we talked about? That seems like a major problem with traditional real estate and even crowdfunding.
This is perhaps the most exciting potential benefit that proponents point to, enhanced liquidity. Traditional real estate is notoriously illiquid. Selling a property or even a stake in a private partnership takes time, significant effort, and often involves substantial transaction costs.
Right, it's not like selling a stock.
Not at all. Tokenization, in theory, breaks down property ownership into smaller, standardized, digitally tradable units, the tokens. Imagine being able to buy or sell a fractional interest in a property on a specialized digital exchange almost instantly, 24/7, much like you trade stocks today.
Wow, that would be a complete game changer, making real estate investment much more flexible and accessible.
It really could revolutionize the market, making it far easier and cheaper for investors to enter and exit positions, assuming the secondary markets develop robustly.
Okay, lower costs, better liquidity potential. What other benefits are mentioned?
Tokenization also offers the potential for increased transparency over ownership and equity. Because blockchain is often a public, or at least permissioned but transparent, immutable ledger, ownership records and the history of transactions can potentially be verified much more easily and transparently by anyone with access to the network.
How does that help?
Well, it could reduce the risk of fraud, make due diligence faster and cheaper, and potentially lower legal costs associated with things like title searches and verification. The immutability means once ownership is recorded, it's extremely difficult for someone to falsely claim ownership or hide things like lien-ins or encumbrances that should be public.
So potentially more trust baked into the system and lower legal burdens. And you mentioned increased access earlier in connection with tokenization. How does that work?
Yes, in a couple of important ways. Firstly, by allowing for the creation of very small fractional tokens representing just a tiny piece of a property, it could further lower the minimum investment barrier compared to even traditional crowdfunding platforms.
Even lower minimums?
Potentially, yes. You could theoretically own a token representing maybe just $100 worth or even less of a high-value commercial building. This could make direct ownership in specific properties accessible to a much wider global audience than ever before.
Global audience.
Yes, that's the second point. Because blockchain networks are inherently global and often permissionless, depending on the specific setup, it could dramatically increase awareness of and access to international real estate investment opportunities. Things that might have previously been incredibly difficult or impossible for an individual investor in one country to discover, vet, and participate in another country could become much more feasible.
Okay, so tokenization promises potentially lower costs, increased liquidity, greater transparency, and even broader, more fractional global access. This technology really does seem poised to address many of the historical pain points in real estate investment.
It absolutely does, at least in theory and potential. And this, finally, is where we can connect the dots right back to our earlier detailed discussion about the accredited investor definition and its limitations.
Ah, the synergy you mentioned at the start. How do the challenges in the accredited investor definition and the potential of these emerging markets like tokenized real estate actually intersect? What's the connection?
This is where the argument for further regulatory evolution becomes really compelling, I think. The sources strongly suggest that these emerging markets, like tokenized real estate, need a critical mass of investors and capital to truly realize their potential.
Critical mass, meaning enough participants to make it work well.
Exactly. Enough participants to develop robust liquidity on secondary markets, enough capital flowing in to attract more high-quality projects and sponsors to tokenize their assets, and enough activity to build out the necessary infrastructure, the exchanges, the custodians, the legal framework.
Okay.
However, the current limitations imposed by the accredited investor definition, particularly its very limited expansion for individuals based on actual knowledge rather than just wealth, act as a significant constraint on building that critical mass.
Because the pool of potential early adopters and participants, the people needed to get it off the ground, is artificially restricted by the current rules.
Precisely. It creates that classic chicken and egg problem that often plagues new market development.
Explain that.
Well, institutional investors, the big players with deep pockets, who could bring significant liquidity and legitimacy to the tokenized real estate market, they're often hesitant to jump in heavily until there's already established liquidity and trading volume. They want to see a functioning market before they commit large sums.
Okay, they want proof of concept.
Right. But establishing that initial liquidity and volume requires participation from a broad base of investors, often including many individual investors who are willing to be early adopters.
So the institutions are waiting for liquidity that can only really be built if more individuals are allowed to participate first, but the rules are limiting that very individual participation needed to bootstrap the market.
That's the conundrum in a nutshell. The argument, which is strongly supported by the sources we looked at, is that a more expansive definition of the individual accredited investor, one that genuinely incorporates demonstrated financial knowledge and capability beyond just wealth or high income, could provide that crucial initial layer of capital and activity.
How would that help?
More qualified individuals participating would help build that initial liquidity, make the market look more viable and attractive for the larger players to then enter, and likely encourage a greater supply of high-quality, tokenized real estate offerings as sponsors see a deeper pool of potential capital.
It's almost like the regulation originally designed to protect investors in private markets is now, maybe unintentionally, hindering the growth of innovative new markets that could potentially offer new opportunities and benefits.
That's a great way to put it, precisely. And it's worth noting that these emerging markets, including tokenized real estate, often present the potential for potentially higher, or what some sources might call asymmetrical returns, compared to very established, highly efficient public markets like the stock market.
Why is that?
It's often due to factors like information asymmetry in early-stage markets where not everyone has the same info yet, inefficiencies that savvy investors can exploit, or simply the potential for significant growth from a much smaller starting market cap. There's potentially more upside, alongside higher risk, of course.
So, by keeping many knowledgeable but not yet wealthy individuals out, the current definition might be preventing them from accessing opportunities with potentially outsized returns. And it's also slowing down the development of markets that could, if they mature, benefit everyone through greater efficiency and transparency.
That's the core tension, exactly.
Yeah.
The argument is that further modernizing the accredited investor standard, making it genuinely more inclusive based on demonstrated sophistication, not just wealth, could work in tandem, synergistically, with technologies like tokenized real estate.
To achieve what?
To actually help achieve the SEC's own stated goals from the 2020 amendments, promoting broader, more diversified capital formation, particularly for smaller issuers and innovative markets like this, while still protecting investors by ensuring those participating truly understand the risks involved because they qualify based on knowledge, not just bank balance. The conversation is really about finding that right modern balance for the future of investment access and innovation.
Wow, that connects a lot of dots indeed. We started this deep dive with the fundamental challenge of accessing traditional real estate, explored how crowdfunding offers a path to lower that barrier.
A significant step, for sure.
Then we dissected what you really need to look for when evaluating crowdfunding platforms, the deal flow, the transparency, the sponsor quality.
The critical due diligence factor.
We navigated the complex and often criticized history and current state of the accredited investor definition, seeing how it acts as a gatekeeper, often based more on wealth than knowledge.
The key bottleneck.
And then looked ahead to how technology like blockchain and tokenization could fundamentally reshape property investment, offering potential benefits like liquidity and lower costs, but perhaps needing regulatory evolution to fully realize that potential.
It's definitely a dynamic space where technology, regulation, and investor demand are constantly interacting and pushing against each other. We've seen how the accredited investor rule, while intended for protection, has historically limited access based primarily on wealth, and how the recent 2020 changes, while a step forward, haven't dramatically changed that fundamental picture for most individuals.
And we saw how these emerging technologies like tokenization offer compelling potential benefits, but their full realization might depend heavily on broader investor participation, the kind of participation that's currently constrained by those very rules we just discussed.
The tension between protecting investors, which is crucial, and enabling access to potentially high-opportunity private markets, including these innovative new areas, remains a central challenge for regulators and the market alike. It's not an easy balance to strike.
So here's a final thought, maybe for you, the listener, to carry forward as you consider everything we've unpacked in this deep dive. As technology continues to disrupt traditional financial structures and create entirely new avenues for investment, how should we define a qualified or sophisticated investor in the 21st century?
Yeah, what does that really mean today?
Is it solely about how much money you happen to have in the bank or how much you earned last year? Or should it be more focused on what you actually know, your demonstrated understanding of finance and risk? And looking ahead, how can regulations adapt to truly balance necessary investor protection with ensuring equal and fair access to potentially transformative wealth-building opportunities for all, not just for a select wealthy few?
It's a fundamental question, and one that will undoubtedly continue to shape the future of capital markets, innovation, and individual opportunity for years to come.